£6,000 per year, £500 per month, £115 per week, £16 per day doesn't sound like much, but this pretty reasonably sized investment could afford you this £1 million mansion and the 2020 Aston Martin Vanquish for £118,000. Well, if you invested that £500 per month at a 9% annual rate of return, you would eventually end up with £2.4 million. So that's £1.2 million on a house and a car, and it's another £1.2 million in cash in order for you guys to live like kings and queens. Now, whilst that's not exactly how investing works, obviously we know house prices go up with inflation, and by the time you wait for the compound effect to take place over the course of 30 or 40 years, the chances are you're probably not going to be able to get into an Aston Martin Vanquish, and instead you're probably going to want something a little bit more comfortable. But nonetheless, this 6-step process should hopefully help you guys build a multi-million pound investment portfolio over the course of the long term, and hopefully help you guys meet some of the financial goals in which you personally have. But before we dive into it, guys, my name's Mitch. I post all kinds of videos on investing and the stock market. If you do enjoy content like that, hit that big red subscribe button down below, as well drop a like on the video, guys. Really helps out the channel. That being said, let's dive straight into it. So step number one is obviously having £500 per month to invest. The first step to investing is to obviously have the surplus money available in order to be able to do so. And finding an extra £500 per month from your current income may be easier said than done, but here are a few suggestions. The first one being that there is an investing principle or personal finance principle that says that you should pay yourselves first. And in essence, it's a bit of a mindset shift in terms of how you go about reprioritizing saving and spending your money. To put this into context, most people, once they've been paid at the end of the month, use that money on mortgage, bills, Netflix subscriptions, eating out, clothes, and they spend all of their money first. And then once they've spent all of that money, they then try and save whatever's left after spending. Whereas if you pay yourself first, you spend what's left after saving. It's a flip mentality whereby you save first, you can set up an automatic savings plan to withdraw some money into a savings account, and then you only spend what's left after saving. So firstly, if you don't already do this, be sure to set something like this up, because if you look after your money will look after you. Now, in terms of more practical ways in order to live a little bit more frugally, here are a couple of examples. The first one being cut down on those little luxuries during your weekly shop down in Asda. Forget about buying those extra few chocolate bars or even those extra couple of bottles of wine, because whilst we're only talking about the equivalent to about £15 to £20 extra per week, those numbers really do add up. The second tip is to go on comparison websites like GoCompare in order to swap your providers for absolutely anything in which you have in order to save a few quid. As an example, my house insurance has just come up for renewal, and the renewal price was £5 more expensive this year than what it was last year. However, going on to GoCompare, I can get a home renewal price for about £25 cheaper. Now, obviously that doesn't sound like much, and the £25 obviously won't get you right the way up to that £500. However, if you look to do this across all of the bills in which you have, whether that's utility bills, car insurance, home insurance, whatever it may be, all of those pounds really will add up, and you could probably save yourselves a couple of £100 per year very easily. The third one being, and this is a bit of a common one, don't get sucked into the renewals on your phone contracts, because you might end up paying more than you were before. Instead, keep the same phone in which you have and look to potentially go into a SIM-only contract, or perhaps get a cheaper phone tariff instead. Number 4, and this is another real common one, is car payments. If you are currently driving around in either a brand new vehicle, or even if you have a really big car loan but you can't afford to invest £500 per month, then fundamentally you need to get a cheaper car. If none of those give you those extra few £100 per month in order to be able to invest, be sure to go onto Google, search some frugal living hacks, and hopefully try and save yourselves a little bit of extra money and make your paycheck go that little bit further. Now, I don't always like to talk about things from a scarcity mindset where you're always looking to cut back, and instead I think there's certainly a happy medium between obviously being able to cut back and living a little bit more frugally and looking after your money where possible, but also looking to have that more expansive mindset whereby you look to increase your income as well. So go for that promotion at work in which you've always wanted, start a side hustle, start a YouTube channel. The options are absolutely endless, and £500 per month really is achievable if you put your mind to it. Step number 2 is to have a minimum of a 3 to 6 month emergency fund in place. Now, this certainly might sound like a boring point to make, but it's certainly a really important one. It's one of the personal finance principles that I think that every single person out there should certainly look to adopt. The reason being, it will provide a great amount of financial security to have 3 to 6 months of your monthly expenses held in cash somewhere in your current account, held in savings, just in case there's a rainy day at some point in the future. Now, the reason why I say this is because the last thing that I would want anybody to do is to invest their last £500 in which they have to their name in order to hope that it will double to £1,000, £2,000, £5,000 or beyond. I'm seeing a lot of appetite for high risk speculative investments right now, and whilst there's certainly a place for that in any investment portfolio, it certainly shouldn't be the only strategy in which you look towards in order to go from rags to riches. So because of that, make sure you are in a financially secure and stable position before you look to invest any amount of money into any asset class. And you can do that quite simply by making sure that you have 3 to 6 months of emergency funds held in cash somewhere just in the savings account, just in case there are any unexpected or unwanted expenses in which crop up. Step number 3 is to get some background knowledge on investing. I really can't express the importance of this enough, and there's a quote from Warren Buffett which says, "The risk only comes when you don't know what you're doing." I certainly spent a couple of years studying the stock market. I studied investing. I studied the topic of investing before I even looked to put a single penny into the stock market or any investment account in which I currently hold. But once I'd already done a lot of the background reading, I was very, very comfortable at the time to start investing. I knew exactly what I wanted to invest into. I knew exactly what my risk appetite was. I knew exactly what my investment objectives were. And because of that, I was far more comfortable when looking to invest my money into the market. Once you get to that place of comfort, which usually comes from having a lot of background knowledge about the thing in which you're doing, that's only the time at which I would say that you're probably ready to start investing. Sounds very cliche, but invest into your education before you start to invest your money. Now, to give you guys a starting point, 2 books in which I recommend are Tony Robbins' Money Master the Game and The Intelligent Investor by Benjamin Graham. And I'll leave links to both of these books down in the description below in order for you guys to pick up. Step number 4 is knowing what to invest into. Different people take different stances on their investment strategy, which will largely be dependent on their capital availability, their risk appetite, and their investment objectives, and their stage of life as well. For me personally, I'm looking for capital growth within my investment portfolio, which is why I have slightly higher risk investments, you could say, with the likes of diversified funds, as well as some high growth stocks in which I have on my trading 2-on-2 portfolio. I know historically that the S&P 500 has returned about 9.8% per year, so because of that I have quite a lot of exposure to a Vanguard S&P 500 ETF. But alongside that, I also have exposure to quite a few growth stocks within my trading 2-on-2 stock portfolio, with companies like AMD, Apple, Amazon, Tesla, Palantir Technologies, and Tattooed Chef. However, if you're a little bit later on during your investing life, perhaps you want to look to stabilize your investment portfolio and perhaps even draw an income from it. You can certainly do that by investing into less volatile assets like bonds as an example, or as an alternative you could look towards one of the lower risk Vanguard Life Strategy funds. Regardless of your approach, one quote in which I'll leave you with for step 4 goes like this: "Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas." Step number 5 is to be consistent. Once you know what you want to invest into, make sure you're consistent with those investments. This approach or strategy is also known as cost averaging, and it's a way in which you invest into the market during regular time intervals, and it's the approach and the strategy in which I personally use for making my investments. Every single month I invest a consistent amount of money into a predefined list of stocks in which I have within my investment portfolio, because inevitably consistency will drive growth over time. To give you guys perspective, here's my Vanguard UK investment portfolio, which I started with just £400, which has now grown to just shy of £17,000 with a gain of about £4,400 as at recording this video. The way in which I like to look at investing is like building a house. You kind of lay those first few bricks, and then when you take a step back it doesn't seem like much, but then over time the more bricks you lay the foundations, and inevitably you end up with a fully grown house. Investing is kind of the same thing. When you first start to drip feed that first 100, 200, 500, £1,000 into the market, it doesn't feel like much, but over the course of time, once you've built those foundations, once the compound effect starts to take place, that's when you'll see the kind of full picture and really start to see the wealth in which you'll certainly generate from investing into the stock market. And in light of that, step number 6 is to think long term. There's a famous quote from Albert Einstein on compound interest, and he says, "He who understands it earns it, and he who doesn't pays it." Now, this certainly couldn't be more true, because if we look at the net worth of individuals like Warren Buffett as an example, you can see the majority of his net worth has come during his later years in life. So putting all of this into context, investing, especially during the first few years, might not seem all that rewarding, because you might not be actually gaining that much in a physical pound and pence amount. However, over the course of 10, 15, 20, 30 years, once the compound effect really starts to take place, assuming that you've also been able to achieve some really solid, consistent returns over time, at which point you should certainly be making some real financial gains, which will not only benefit you personally, but it will also benefit the loved ones in which you have around you. So that's certainly how it goes, guys. They're the kind of principles in which I've personally followed, and as a result, over the course of the past 3.5 years or so, I've been able to build a £40,000 investment portfolio. And if you guys apply the same principles, I'm sure all of you guys can go on to achieve all of the financial goals in which I'm sure you all have. So with that said, guys, be sure to let me know what your financial goals are down in the comment section below. As well, guys, if you did enjoy the video, be sure to drop a like on it, subscribe to the channel if you're new around here, and with that being said, I'll see you over in the next video.